We own $240 billion worth of stocks. Now, we look at that as $240 billion worth of businesses that we own parts of. But I love owning those businesses.
You've also got more than $125 billion in cash sitting around.
Yeah, well, we'd like to buy more businesses. There's always going to be some news, good or bad, every day. In fact, if you go back and read all the papers for the last 50 years, probably most of the headlines tend to be bad. But if you look at what happens to the economy, most of the things are extremely good. I mean, it's incredible what will happen over time.
Warren Buffett, one of the greatest investors of all time, was recently interviewed on CNBC. During the interview, Buffett was kind enough to share his thoughts and investing strategy that could help many investors look to multiply their money during a stock market crash in 2020. Let's get straight to it. Here are 10 tips from Warren Buffett during a stock market crash in 2020 for beginners. These 10 tips are helpful for beginners investing in the stock market during a stock market crash. Tip number 1, don't panic. There will always be headline news of trouble coming. Only buy stocks if you get enough for your money.
There's a lot of wretched excess out there, and that there's a lot of trouble coming as a result. Do you agree with that?
There's always trouble coming. Yeah, there was trouble coming in 1942 when I bought that first stock. All kinds of trouble. Philippines were going to fall pretty soon. There was all kinds of trouble in 1949. There was trouble, certainly trouble in 2008 when I wrote an article for the New York Times. I said trouble is coming, but I said buy stocks.
Would you repeat that this time? If trouble's coming, would you still say buy stocks right now?
I would say buy stocks if you get enough for your money.
If you're looking to level up your money like Warren Buffett, make sure to click that like button. On to the next tip. Tip number 2. Everyone starts their investment journey as a beginner. Make sure to have a long-term investing strategy when buying businesses. You don't sell a business based on today's headlines. Short-term fluctuations up and down are expected. Look upon lower prices as discounts to buy stock at cheaper prices. Let's listen in to Warren.
First day I bought stocks was March 12th, 1942. And the stocks were down about 2% that day, as it turned out. Unfortunately, I bought in the morning, so when I came home in the evening, and my dad told me the execution price, it was down 2%. But if you're buying a business, and that's what stocks are, businesses. In fact, people will be better off if they say, I bought a business today, not a stock today, because that gives you a different perspective on it. Then, presumably, if you buy a farm, if you buy an apartment house, if you buy a business, you're going to own it for 10 or 20 or 30 years. And the real question is has the 10-year or 20-year outlook for American businesses changed in the last 24 hours or 48 hours? And you'll notice many of the businesses we own, partially own. American Express, we've owned it for 20 years. Coca-Cola, we've owned it for 40 years. Those are businesses. And you don't buy or sell your business based on today's headlines. And if it gives you a chance to buy something that you like and you can buy it even cheaper, then you're good luck, basically.
Tip number 3. Nobody knows what the stock market is going to do, so make sure to know the main reasons of why you are buying shares of a company.
I don't think anybody knows what the market's going to do. I think you do know whether you're making an intelligent purchase at a given price. Everybody, when they buy a stock, if you're going to buy, say, General Motors that has 1,400,000,000 shares out, you should be able to take a yellow pad like you have there and on one page say, let's say it's selling for 30. It isn't selling that low, but that'd be $42 billion. You should say, I am buying the General Motors company for $42 billion because, and you should get it on a piece of paper. And then if you want to have a separate piece of paper, it says, I think I know what the stock market's going to do, so I know whether it'll be higher or lower in it. But you don't.
Tip number 4. Because you can't predict the market, don't trade stocks day to day, even if your smartphone stock app allows you to buy and sell quickly.
Forget about the market. If you can predict the market, you don't need to read balance sheets. You don't need to read anything. You certainly can't predict the market by reading the daily newspaper. That is for sure. And you certainly can't predict the market by listening to me. And you can't pick them from day to day. If you can do that, you can Well, I haven't met anybody yet that knows how to do it.
Tip number 5, always look upon stocks as businesses. Businesses are not just stock tickers on your smartphone.
But you're buying businesses. And if you had planned to buy a local service station yesterday and it was closing today, I don't think you'd tear your hair out or anything like that. You'd have already looked at where it was located and the contract it had with the suppliers and made a decision on competition. People, because they can make decisions every second in stocks, whereas they can't with farms, they think an investment in stocks is different than an investment in a business or an investment in a farm or investment in an apartment house. But it isn't. If you get your money's worth in terms of future earning power over the next 10 or 20 or 30 years, you're going to have made a good investment.
Tip number 6, we get rich based on retained earnings.
We don't get rich on our dividends that we receive, although we're happy to receive them. We get rich on the fact that the retained earnings are used to build new earning power, repurchase shares, which increases your ownership in the company. And Berkshire has retained earnings ever since we started. That's the only reason Berkshire's worth a lot more, as we retain earnings.
Tip number 7, you get more for your money in stocks than bonds. 3 alternatives being 1, short-term cash, number 2, long-term bonds, and number 3, long-term stocks.
You get more for your money in stocks than bonds. That doesn't have to be the case. I mean, but it's usually been the case in America, very usually been the case. And if you buy a 30-year bond today with a yield 2%, you're paying 50 times earnings for an investment where the earnings can't go up for 30 years. Now, if somebody said, I want to sell you a stock that's at 50 times earnings and the earnings can't go up for 30 years, you'd say that doesn't sound very good. Stocks are way better than 30-year bonds. I mean, that's clear. And that's one of the alternatives people have. People really have 3 basic alternatives. Short-term cash, which is an option of doing something later on. Long-term bonds or long-term stocks. And stocks are cheaper than bonds.
Tip number 8, look for companies that sell products or provide a service that can change the world over a long period of time. Warren discusses Apple as one example.
It's really interesting, you know, we call them smartphones. If you go back and look at the old telephone, that was an incredible, useful product. It changed my mother's life and my dad's life. It changed lives in every way. And they took a long time to become pervasive, and it was very expensive initially, but it changed the world. And the smartphone is part of hundreds and hundreds of millions of people's lives in all aspects of their lives. It's used as all kinds of utility. It's a consumer product.
Tip number 9, the long-term outlook, in Warren Buffett's opinion, is easier to predict compared to the short-term outlook when it comes to the growth of American business.
I don't have the faintest idea what our businesses will be doing 6 months from now or 12 months from now. I do think that not only our businesses, but American business generally will be doing fabulously better 30 years from now or 20 years from now. And the long term is in my view, is very easy to predict in a general way, but an important way. I don't think there's any way to predict what the stock market will do 10 minutes from now, 10 days from now, or 10 months from now. So I work on what I think I'm able to do. And as desirable as it might be to know what was going to happen 10 minutes from now, that's just not something I'll ever be able to master. So fortunately, I can come to a pretty firm conclusion that 20 or 30 years from now, American business, and probably over the world, will be far better than it is now.
And last but not least, tip number 10, buy stocks at a young age as long as you are buying value based on your research.
Or I've actually been a personal net buyer of stocks ever since I was 11, every year. And there's been 15 American presidents in my lifetime, more than a third. I've lived under a third of the life. I didn't buy stocks under Hoover. I was only about 6 months old then. But there have been 7 Republicans after that and 7 Democrats. I bought stocks under every one of them. Now, I haven't bought stocks every day. There have been a few times I thought stocks were really quite high. And I've even written an article once or twice, but that's very seldom.
Let's end this episode with a quick update of one of my personal stock portfolios that I've been documenting in every episode so far, starting from $0. My stock portfolio on your screen is a little over $2,200. Remember, these positions are still very small since I'm trying to help beginners looking to invest in the stock market with little money. I have plans to continue to deposit more money into the stock portfolio as we level up over time. Remember, we are just getting started. Any signs of a pullback are welcomed, in my opinion, since I'll be able to reduce my cost basis. As always, do your own research prior to making any investments. Read the disclaimer on your screen fully. Remember, all opinions in this episode are mine and mine alone. I'm not a financial advisor, and this episode is for entertainment and informational purposes only. Let's keep building from zero to infinity. Hold on tight for the ride. Peace.